While the headlines told you the US-China trade war was easing, a far more dangerous move was quietly locked in, one that could choke America's silver supply starting January 1st. In November, global markets breathed a sigh of relief. News outlets celebrated what they called a thaw in US-China trade relations. Beijing suspended export controls on several high-profile materials, rare earth elements, gallium, germanium, even antimony. Analysts rushed to declare victory. Commentators spoke of de-escalation. Wall Street applauded. But beneath that wave of optimism, something far more consequential went almost completely unnoticed. China never loosened its grip on silver. In fact, it quietly set a hard deadline, January 1st, 2026, a date chosen not by chance, but by design. This isn't another routine policy adjustment or bureaucratic technicality. It's a strategic choke point that fundamentally alters how silver flows into the U.S. economy. And once that date arrives, American buyers won't be dealing with a global market anymore. They'll be negotiating directly with Beijing's approved gatekeepers. To understand how calculated this move really is, we need to rewind to October of last year. That month, China exported an astonishing 60 metric tons of silver, the largest monthly export total on record. The metal flowed into London metal exchange vaults, COMEX warehouses in New York, and Swiss refineries supplying Western buyers. On the surface, it looked like business as usual: strong demand, healthy supply, normal trade flows. But in reality, it was something else entirely. It was a final rush, exporters moving every ounce they could before the door slammed shut. Chinese producers understood what most Western analysts missed. They knew the export environment was about to change. Starting January 1st, the rules would no longer favor open market transactions. So October wasn't about meeting demand, it was about clearing inventories while freedom still existed. Think of it like the final outbound flights before a country closes its borders. Once the clock runs out, there's no boarding pass left to buy. Today, silver trades around 62 per ounce, up more than 100% since early 2025. The previous all-time high has already been blown past. But this rally isn't driven by speculative mania or retail excitement. It's positioning. Large buyers are preparing for a structural supply shock that hasn't fully hit yet. The real turning point lies in a policy most people haven't read. Instead of banning silver exports outright, China's Ministry of Commerce implemented something far more effective: a licensing system that centralizes control. Beginning January 1st, only companies producing at least 80 tons of silver per year, or 40 tons in select Western regions, can even apply for export approval. That immediately eliminates hundreds of private exporters and independent traders. Fewer than 20 companies nationwide qualify, and every single one has deep ties to the state. If you're a U.S. solar manufacturer needing silver for next quarter's production, the rules have changed. You no longer negotiate based on price discovery and supply-demand dynamics. You negotiate with state-approved exporters who answer to Beijing, not the market. Spot purchases disappear, flexibility disappears, and leverage disappears with them. The timing of this move is no accident. January 1st was chosen for three very specific reasons. First, it follows the highly publicized November negotiations where China appeared to concede on other critical minerals. While Western leaders claimed success and media narratives shifted toward cooperation, silver remained quietly restricted. It was classic misdirection. Give away what you can afford to lose while holding tight to what truly matters. Second, January aligns perfectly with the U.S. industrial procurement calendar. American manufacturers finalize first quarter supply contracts in mid-December. But this year, the list of approved Chinese exporters won't even be published until late December. That leaves buyers scrambling with virtually no notice, no certainty, and no alternatives lined up. Third, the date coincides with historically low silver inventories inside China itself. Shanghai Futures Exchange warehouses now hold roughly 780 tons, down from more than 400 tons in 2019. Domestic consumption has exploded, especially from solar panel manufacturing, electronics, EV components, medical devices, and water purification systems. China is prioritizing its own factories first and closing the export window at precisely the moment inventories are tightest. If there were any doubt about how serious this situation is, look at what happened next. Just days after China formalized these restrictions, the U.S. Geological Survey officially added silver to its critical minerals list for the first time. That designation isn't symbolic. It means the U.S. government now recognizes silver as essential to economic and national security, with supply chains vulnerable to disruption. In plain language, the U.S. admits it has a silver dependency problem, and China knows it. The numbers confirm it. China's domestic industrial demand for silver now exceeds 200 tons annually, while domestic mine production sits closer to 600 tons. That's a structural shortfall of roughly 600 tons every year, filled through imports and recycling. When exports tighten, that imbalance doesn't vanish, it gets exported to the rest of the world. The licensing framework itself reveals the real intent. Beyond production thresholds, applicants must show massive credit lines, international ISO certifications, full compliance with labor insurance regulations, and documented export performance stretching back several years. These hurdles aren't about quality control. They're designed to eliminate competition and consolidate power. Once the approved list is finalized, it remains locked for 2 full years. Beijing can then tighten or loosen supply simply by adjusting allocations behind the scenes, invisible to outside observers. Meanwhile, stress in the physical market is already obvious. In early 2025, silver lease rates in London exploded from near zero to over 15% annualized. By late summer, they reached levels 30 times normal. Banks struggled to source metal for routine transactions. Refineries in Zurich rationed deliveries even to long-standing clients. Traders across Singapore and Europe reported the same thing: silver was disappearing from circulation. Estimates now suggest that freely available silver, metal not locked in ETFs' vaults or long-term storage, may be under 4,000 tons globally. In a healthy market, that number would be closer to 15,000 tons. The reason is simple. Industrial users aren't waiting for January. They're buying now and vaulting metal while they still can. We've seen this movie before. In 2010, China imposed export controls on rare earth elements. The result wasn't an immediate ban, but prices exploded anyway. Neodymium surged over 500%. Dysprosium rose more than 2,000%. Western manufacturers faced existential shortages. It took years for supply chains to adjust. Silver is even more vulnerable. There's no quick mine restart option. Most silver is produced as a byproduct of copper, zinc, and lead mining. You can't ramp silver output without expanding base metal operations, a process that takes years. And unlike rare earths, silver is often consumed irreversibly. Once it's embedded in solar panels or medical products, it's effectively gone. Globally, silver demand already exceeds supply. Annual demand sits near 1.2 billion ounces, while total supply, including recycling, barely reaches 1.16 billion. That deficit exists before any export restrictions take effect. China alone exports roughly 135 million ounces per year. If exports fall by just 30% under the new licensing system, the global market loses another 40 million ounces. Combined with the existing shortfall, that's an 80 million ounce gap with no immediate solution. Prices must rise to rebalance the system. Either demand gets destroyed, recycling ramps up, or mining expands, none of which happen overnight. At current prices, silver hasn't fully adjusted yet. Analysts projecting mid-60s prices are underestimating the structural shock ahead. Historically, during supply crises, silver outperforms gold. The gold-silver ratio compresses as industrial users bid aggressively for physical metal. Even modest compression suggests silver prices pushing into the 70, the 75 range as equilibrium. Short-term spikes could go higher during acute shortages. The timeline is tight. December 31st marks the end of open exports. January 1st introduces state-controlled licensing. By mid-January, U.S. manufacturers finalize contracts only to discover delays, bottlenecks, and reduced availability. The result is a supply gap that forces buyers into bidding wars for non-Chinese silver. This isn't speculation. The policy is published. The math is public. The inventories are verifiable. Short-term volatility may occur, but the structural setup is locked in. China chose January 1st not because it's symbolic, but because it's strategically devastating. The only real question left isn't whether silver prices rise. The numbers guarantee that outcome. The question is whether you're prepared for what happens when the world realizes the supply lines were cut before anyone was paying attention.